Sometimes the loudest sound in a crisis is the quiet click of people turning off their screens, not because they don't care, because the shouting adds nothing, because somewhere inside they already know what they need to do, and noise just makes it harder to hear. If you're feeling dread in your stomach, that feeling is familiar to me. It's the same feeling I had in other seasons that looked like this. When easy money vanishes, fear replaces it, and the things that looked obvious suddenly look fragile. People think a crisis starts when headlines say it does. In my experience, it starts in private, when a family opens a bill they can't pay, when a business owner looks at a line of credit that won't extend, when an investor realizes their appetite for volatility was borrowed confidence. The public part is just the echo. I've seen this movie more than once. I've seen the same plot with new actors. The costumes change, but the ending doesn't. When I was young, I thought intelligence was a shield. If I could just be smart enough, I'd never get caught. Funny thing, history doesn't care how smart you are. It rewards the patient, the disciplined, and the well-prepared. And it humbles the clever who thought they could outdance a fire. I remember the day my margin clerk called in a bad season. Back then, I thought leverage was a sign of confidence. That day I learned it was actually a promise I'd made to sell at the worst possible time. Not because I wanted to, because I had to. That lesson stuck. Pain is a sticky teacher. Let me say something important. If you're feeling confused right now, you're in good company. Even seasoned people feel it. On the outside, insiders look calm. On the inside, they've spent months tightening sails, trimming risk, and choosing which storms to sail through and which to avoid. That's not special access, that's muscle memory. Most people aren't unprepared because they're irresponsible. They're unprepared because the world was whispering, "It's fine, it's different, money is easy." And that whisper felt good. We all like good news. We all like low rates, rising prices, simple stories. We are human. So here we are, the sort of crisis that the wiser investors always predicted, not by predicting the day, but by predicting the behavior. Excess is always followed by regret. That doesn't make you a prophet. It makes you a student of human nature. The mistake is thinking the emergency is out there. The emergency is not the headline. The emergency is what happens to your plan when the assumptions change. So let's reframe this quietly. The emergency isn't the market falling. The emergency is being a forced seller. That's the difference between a bruise and a broken bone. The emergency isn't a recession arriving. The emergency is your spending being higher than your dependable income when credit tightens. The emergency isn't volatility. The emergency is volatility plus leverage. The emergency isn't that prices change. The emergency is that you set up your life so they couldn't. You don't have to predict when storms come. Your job is to build a boat that floats in all weather, and to know why you built it that way. That's all this is. Here's a second reframe. Insiders aren't magicians. They're just the people who stopped asking, "How do I make the most?" and started asking, "How do I make enough and keep it?" That question change is where calm comes from. Let's talk about the boring math that rescues people. If your portfolio falls 30%, you need a 43% gain to get back to even. That isn't tragic. It's just arithmetic. The tragedy comes when you sell at a 30% loss because you needed the money. That turns a math problem into a time problem, and time is the compounder you can't afford to lose. If inflation sits at 3% and your cash earns 0%, your purchasing power halves roughly every 24 years. That sounds scary, but remember, cash is a tool. It isn't your engine. You don't keep all your wealth in a wrench. You keep the amount that fixes problems quickly. The rest belongs in assets that work while you sleep. If you spend $4,000 a month and you hold 12 months of cash-like reserves, that's $48,000 set aside. At current yields, that cushion might earn a few $1,000s a year. Nothing to brag about. But it buys you time, the one asset that turns panic into patience. If a business earns $1 per share and you pay $10, that's a 10% earnings yield before growth. If you pay $30, that's about 3.3%. The same business, the same store. The difference is your price. When prices compress in a crisis, your future return rises. That's the quiet gift of bad markets. Bad markets are just future good returns wearing a scary mask. None of this math is impressive. It's boring. And boring math is what makes people wealthy. So how do you move through a season like this without losing your head or your plan? I'll share what I learned the hard way, not as commandments, as observations from decades of bruises and a few old journals. First, cash is not an investment. Cash is an option to not sell what you love at a price you hate, an option to buy what you admire at a price that's finally fair, an option to sleep. The worth of that option is highest when the world is most afraid. People say, cash is trash. In a storm, cash is a life vest. You don't wear it forever. You wear it until the boat stabilizes. Second, never let interest pick your future. Fixed-rate debt with a long term is a leash you can measure. Variable-rate debt is a leash that tightens when you're least able to handle it. When money is easy, variable feels smart. In a crisis, it becomes a landlord that raises your rent without asking. Third, separate your survival money from your opportunity money. Survival money pays for groceries, housing, insurance, and calm. Opportunity money buys the future. The tragedy happens when people blur the two. They use opportunity money for survival and are forced to sell their future in a panic. Keep them apart. Label them in your mind and, if you need to, in your accounts. Fourth, plan your behavior before the headlines. If the market fell 40%, what would you do? Put it on paper when you're calm. At down 20%, I do nothing. At down 30%, I add 5% to equities. At down 40%, I add 10% more, funded from the opportunity bucket. Will it be perfect? No, but a written plan beats improvisation. Improvisation is just panic wearing lipstick. Fifth, spend from income, not principal, whenever you can. If you need to draw 4% from a portfolio to live and the portfolio temporarily takes a dive, draw from the safe bucket. Your goal is to avoid selling shares at fire sale prices. If you must sell, sell slowly. Slow defeats fear more than smart does. Sixth, remember sequence risk. If you're near or in retirement, the order of returns matters far more than the average. A bad first 3 years hurts more than a bad seventh. That's why retirees should have several years of conservative runway. Not because you fear return, because you respect time. Seventh, don't confuse movement with progress. The most dangerous time to trade is when your emotions are loud. The best time to act is when your plan is clear. I've made my worst choices when I couldn't stand still. Standing still feels like doing nothing. In investing, waiting is doing something in disguise. Eighth, measure what you can endure. Risk isn't volatility. Risk is what causes you to abandon your plan. If a 25% drawdown makes you sell, your risk was too high. Not because your math was wrong, because your nerves were. Your temperament is part of your portfolio. You can't outsource it. Ninth, insist on a margin of safety in everything: your spending, your business model, your investments, your assumptions. If your plan works only when rates stay low, employment stays high, and prices keep rising, that's not a plan, that's a wish. Wishes are expensive. 10th, know the difference between price and value. In a mania, price hides risk. In a crisis, price reveals value. The quieter you become, the more that difference becomes obvious. Value is cash you can count, customers who return, contracts that stick, assets that earn with or without a press release. People ask me, what are the insiders doing? The ones I respect are doing unglamorous things. They're letting cash build not because they love cash, but because they love options. They're redeeming leverage quietly, because in a storm, every liability is a claim on your future. They're looking at businesses that can raise prices a little without losing customers. They're rolling short-term debt to longer maturities while lenders are still answering the phone. They're reviewing covenants before they become headlines. They're trimming what they don't understand and keeping what they would own even if markets closed for 5 years. That's not fancy. That's homework. Let's go back to simple math for a moment. Say you invest $500 a month for 30 years and earn a calm 7% annual return. No heroics, no timing, just doing it through thick and thin. You end up around $600,000 before taxes. If that sounds unimpressive, remember 2 things. First, you did it while living your life, not staring at quotes. Second, in many seasons, a simple positive real return beats the pants off most active behavior. Now, imagine you stopped investing for 5 of those years because headlines scared you and waited to feel safe. You might miss the best forward returns. Skipping 5 years could cost you more than the worst 5 years ever would have. That's the paradox. The returns show up when comfort leaves the room. When prices fall, your new contributions buy more ownership. In a crisis, your dollars are finally powerful again. That's why I say to people in their earning years, your future is on sale. It doesn't feel like it. It never does. If you're not adding, you're preserving. 2 to 5 years of essential expenses in cash-like assets is boring. Good. Boring made it through every season I've lived. Boring will walk you through this one too. Some folks ask, but what if this time is different? Of course it's different. It's always different in the details. It's never different in the behaviors. Fear, greed, overconfidence, envy. These are old songs. The melody doesn't change. If you need a compass for what to own when the ground shifts, consider 3 traits. 1. Durability. Things that people need in any season. Food, energy, simple healthcare, basic software, low-cost connectivity, essential infrastructure. 2. Pricing power. A little, not a lot, enough to keep up with costs without losing trust. 3. Balance sheets that can survive a nasty winter. Debt is not a sin, but it is a promise, and promises come due in storms. You don't have to pick heroes. You just have to avoid liabilities disguised as opportunities. The more complex a story, the more likely it was built to sell to you, not to serve you. There's another quiet reality. Bad seasons are when the best businesses get better. Their weaker competitors can't survive the drought. They gain customers. They buy assets cheap. They emerge with more share and more endurance. If you can own a piece of that and wait, your patience will be paid in the only currency that matters, free cash flow that arrives without drama. In your personal finances, think like a farmer. Trim your spending like a farmer trims water in a dry year. Not forever, just until the rain returns. If your spending is $5,000 a month, see if you can live at $4,200 for a while. That extra $800 a month might be the difference between forced selling and optional patience. Don't cut the things that keep your engine running: health, basic insurance, time with people who matter. Cut ego costs. Ego is expensive. Dignity is cheaper than it looks. If you own a home with a fixed mortgage, protect it. If you have variable debts, try to fix them or reduce them. If you're renting, consider stability over flash. A long lease at a reasonable rate is a better partner than a fancy building at a stretched budget. If you lead a small business, Call your lender before you need to. Clarify your covenants, extend your maturities, build a cash buffer, and pay vendors on time. Recessions reward businesses that act like adults. The bar is lower than you think. In hard times, reliability is a marketing strategy. Let me share a memory. In one of the bad seasons, I sat with a couple who had delayed retirement for years because the market kept scaring them back to work. They had enough on paper, but no plan for drawdowns, so fear owned their calendar. We built a simple policy. 3 years of a spending runway in safe assets, rebalanced annually, a spending rate that could flex a little when markets were sour, no more than 60% in volatile assets, and a vow: no television during the worst weeks. 5 years later, they weren't rich by magazine standards, they were rich by my standards. They had time on Tuesdays to see their granddaughter's school play. That is the point. That's why this channel exists. Quiet wealth is not about being clever. It's about being steady. When you hear people say, "The crisis is here," I want you to translate that into, "The test of my habits has arrived." If you built the right habits, the test will feel like work, not like terror. If you didn't, the second best time is right now. Not to buy whatever's fallen. To build the habits that let you keep whatever you buy. A word about predictions. People keep searching for the person who called it. I promise you, those people will multiply after the fact. Anyone can predict 15 things for 10 years and be crowned when one of them lands. What you want instead is a philosophy that doesn't need predictions to survive. The ship captain who only sails on sunny days doesn't need skill. The captain who knows his vessel can handle swells is the one you can trust. Let's do one more piece of simple math to anchor your thinking. If you buy the market at an average valuation and hold for 20 years, history suggests you'll capture something like 6% to 8% annualized, depending on your starting point. If you buy during times of fear when valuations compress, your future return often climbs a notch. If you buy during times of euphoria, the future return often sags. That's not prophecy. It's algebra with emotions removed. You don't have to be perfect. You just have to avoid buying long confidence at a short price. What about bonds and cash? In seasons like this, short-term high-quality bonds and treasury bills can pay you decently while you wait. Not exciting, just useful. Think of them as your oxygen tank while you swim under the wave. After the wave passes, you can resurface and keep swimming with lungs full and a clear head. One more principle I wish I'd learned earlier. Make your list before you go shopping. The best investors I know keep a small watch list of businesses they'd gladly own at the right price. They define right price when skies are clear. Then they wait. During storms, they don't wander the aisles grabbing whatever looks discounted. They already know what they came for. Some years, they go home empty-handed. That's fine. Emptiness is still better than buying junk that on sale still isn't cheap. And please, measure wealth in quiet. Wealth is not the car payment. Wealth is the absence of payments. Wealth is not the number on a brokerage screen at midnight. Wealth is waking up knowing that if it all goes sideways for a year, your life doesn't. Wealth is not never worrying. It is worrying about fewer things, and none of them are monthly bills. So, if this season has you worried, let me offer you a calm plan you can adapt. Start by checking your runway. Count months of essential expenses you can cover without selling long-term assets. If the number stresses you, prioritize raising it quietly over the next year, not by chasing yield, by cutting ego costs, delaying non-essential purchases, and letting a boring cash-like bucket fill. Next, name your buckets: survival, opportunity, and long-term compounding. Put dollar amounts to each. Even if it's just mental, the labeling stops the leakage. Money without a name tends to run toward drama. Then, audit your debts. Fix what you can, shrink what hurts, and shun new promises that depend on perfect weather. Revisit your spending rate. If you're drawing from investments, build a little flex. A 3% to 4% base with a willingness to trim in tough years will outlive most storms. Write down your market behavior plan in a single paragraph. Keep it simple. If markets fall by X, I will do Y, funded by Z. Put that note where you can see it. Future, you will thank you for giving them instructions when their hands are shaking. Finally, do your watch list homework in calm days, not frantic ones. Then turn down the volume. Most of what's being said is not for your benefit, it's for theirs. If I could hand you only one sentence to keep, it would be this. Your job is not to predict the storm. Your job is to never need to. If you do that, every crisis becomes survivable. Some become profitable. All of them become less interesting than your actual life. I often think about what life looks like 10 or 20 years from now for someone who lives this way. It doesn't look like yachts. It looks like mornings that start without alarms. It looks like a paid-for house with creaky floors you know by heart. It looks like dinners where the bill doesn't change your mood. It looks like the power to choose your work and your company. It looks like long walks after storms, checking for fallen branches rather than rebuilding your home. You won't brag. You won't need to. The return you'll enjoy is not the number in a spreadsheet. It's the feeling that your time belongs to you. One last story. I knew a man who, at 50, realized he'd spent 3 decades trying to be interesting. He'd chased the new thing, traded the short term, and had 1,000 stories, and very little to show. He made a quiet decision. For the next decade, he would be boring financially and interesting in life. He automated his investing, reduced his risk, paid off his debts, and said no to almost everything flashy. At 60, he had fewer stories about markets and more about people. He wasn't richer than everybody. He was richer than he used to be. Most importantly, fear didn't own him anymore. That's freedom. If you enjoy this kind of quiet, long-term thinking, you might enjoy what we do here at Quiet Wealth. You're welcome to subscribe. In every cycle, people say, this time is the big one. Maybe, maybe not. It doesn't matter to our plan. Our plan is built to outlast the conversation. We will hold enough cash to sleep, enough quality to endure, and enough patience to let compounding do what it does best. Turn small, repeated good choices into a life we're proud of. When the tide goes out, as Mr. Buffett likes to say, you find out who's been swimming naked. It's a funny line, but there's another version I prefer. When the tide goes out, you also find out who built a simple dock above the waterline and brought a towel. Build the dock, bring the towel, and let the tide do what it always does. You don't need to be a genius. You need to be unshakable in the basics. Hold your plan like a lighthouse. The waves can be tall. They cannot move the rock. In a week or a month, the headlines will change their tone. They always do. What you will have, if you act now in a calm way, is a set of habits that won't. That is the secret the insiders aren't hiding. It's just too boring to sell. Patience, preparation, and the willingness to let quiet math work over loud time. The crisis isn't an invitation to panic. It's an invitation to maturity. And the payoff for maturity is the rarest wealth of all, peace of mind. We're going to be fine. Not because the world is easy, because you are going to be prepared. Thank you for spending this time with me. I'll be here, like always, doing the same simple things that work, waiting for the seeds we planted to break the surface, and reminding anyone who cares to listen that the big money is made in the waiting, and the real wealth is the life you get to live while you wait.